The future of U.S. interest rates isn't just a headline, it's a pivotal force shaping our collective economic destiny. Every decision from the Federal Reserve reverberates through markets, impacts businesses, and directly influences the trajectory of your personal finances. We stand at a crucial juncture, meticulously examining the signals to anticipate what comes next. Understanding these dynamics empowers us not just to react, but to proactively forge a stronger financial future. This isn't about passive observation, it's about informed action, ready to adapt and thrive. At the heart of the Federal Reserve's mission lies a critical dual mandate, achieving both maximum employment and price stability. These aren't just abstract goals, they are the pillars upon which a robust and equitable economy is built. The Fed meticulously analyzes an array of data, constantly calibrating its policy tools to ensure these two objectives remain in harmony. It's a delicate balancing act, a testament to the complex challenge of fostering an environment where every individual has the opportunity to prosper without the erosion of their purchasing power. This mandate underscores a commitment to sustained growth for all. Inflation has been a dominant narrative, and its trajectory remains a key determinant for interest rates. The Federal Reserve targets a 2% inflation rate, a level considered healthy for sustained economic growth. Recent data, however, reveals a persistent pulse above this comfort zone, with the Consumer Price Index, CPI, recently holding at 3.2% and the Personal Consumption Expenditures, PCE, index, the Fed's preferred gauge, at 2.8%. While progress has been made, this sticky inflation necessitates vigilance. We must observe if this downward trend solidifies, offering the Fed the confidence to pivot, or if new pressures emerge, demanding further restraint. Against the backdrop of inflation, the U.S. labor market has displayed remarkable resilience, a testament to the enduring spirit of American enterprise. The unemployment rate has remained historically low, recently around 3.8%, consistently defying expectations of a significant slowdown. Monthly job creation figures, averaging around 180,000, underscore robust demand for labor. While wage growth has moderated slightly, it continues to support consumer spending. This strong employment picture, however, presents a nuanced challenge for the Fed. It reduces the urgency for rate cuts, as the economy can absorb higher borrowing costs. It speaks to an underlying strength that propels us forward. The bond market often whispers secrets about future economic conditions, with bond yields acting as a collective forecast for interest rate expectations. An inverted yield curve, where short-term bonds yield more than long-term ones, has historically been a harbinger of economic slowdowns or even recessions. Currently, this inversion persists, suggesting that market participants anticipate rate cuts in the future as the economy potentially cools. This market expectation often contrasts with the Federal Reserve's more cautious higher-for-longer rhetoric. Discerning the message from these complex signals is crucial for investors and individuals alike, offering a glimpse into what the future might hold for borrowing costs. The debate within economic circles, and even within the Fed itself, centers around two primary policy perspectives: the hawkish stance and the dovish perspective. Hawkish members prioritize battling inflation, advocating for higher-for-longer rates to ensure price stability is firmly re-established, even at the risk of slower growth. Their belief is that sustained restrictive policy is essential. Conversely, the dovish camp expresses greater concern about the risks of an economic slowdown, advocating for potential rate cuts to support growth and prevent unnecessary contraction. Understanding this fundamental divide is key to interpreting future Fed actions, reflecting the dynamic tension that shapes our economic destiny. Beyond domestic factors, the U.S. economy is inextricably linked to global economic tides. Geopolitical tensions, commodity price fluctuations, particularly oil, and the stability of global supply chains significantly influence inflation and growth prospects. A sudden disruption, such as a major geopolitical conflict or a spike in energy costs, could reignite inflationary pressures, compelling the Fed to maintain or even raise rates. Conversely, a global slowdown could ease demand, contributing to disinflationary forces. Recognizing this interconnectedness allows us to prepare for a world where local decisions are constantly influenced by events far beyond our borders, underscoring our shared journey. As we look ahead, several scenarios unfold for U.S. interest rates in 2024 and beyond. The most likely path involves rates holding steady for a period, allowing the Fed to assess the full impact of past hikes on inflation and employment. A further rate hike would only occur if inflation re-accelerates unexpectedly or the labor market overheats significantly. Conversely, potential rate cuts could emerge if inflation convincingly moves towards the 2% target and economic growth shows signs of sustained weakness. Each path presents unique challenges and opportunities, requiring adaptability and foresight. Understanding these possibilities empowers us to navigate the future with confidence and strategic intent. The question of whether U.S. interest rates will rise is more than a mere economic forecast. It's a call to proactive engagement with our financial futures. By understanding the Federal Reserve's mandate, dissecting inflation and employment data, and recognizing global influences, you gain an invaluable compass. This knowledge isn't just about predicting outcomes, it's about mastering the variables within your control. It's about making informed decisions for your investments, savings, and career path, regardless of the economic climate. Embrace this understanding as a tool to unlock your potential, transforming uncertainty into an arena for growth and opportunity. Your financial destiny is within your grasp.